Okay, good morning, everybody. Thank you for joining us. We're going to talk about state tax returns today. And I asked Janet if we could do this with the idea that I didn't, there's no intention to expect all the staff to be able to prepare state returns, just to recognize them and know what to do when we see them. So that's going to be that's what I hope to achieve in the next hour, is give you just some basic familiarity with a state tax return. So Prosper Tax Help prepares about 200 state returns each year. Now, we prepare over 15,000 total returns, so that's not too many in the scheme of things. However, that's enough that most staff will probably handle a state return at some point, whether it's through the intake process, through helping a drop-off client pick up a return. Remember, drop-off is the group that prepares the state returns. So I want you to be aware, know what to look for. Okay, Texas, this is kind of a foreign concept to us, living in Texas. Texas has no income tax. Texas is one of 9 states that do not have an income tax. That means that there are 40 states, 40 plus states, and the District of Columbia that do impose income taxes. So it's more common than not by a large margin. Why would a state, I mean, it's kind of nice not having a state tax return. I think we'd all agree on that. Why would a state impose an income tax? Well, it goes back to a lot of different variables. There's a history of it, and there are other factors, resources in the state. So I'd like to spend just a few minutes talking about that. I do like to look at the background of things. It's kind of my thing. So thank you for indulging me. Taxes support the government. So we have a government that does what we tell it to do. Different programs, different services. And as the economy grows, since the beginning of our country, the country's grown, the economy has grown, the government has grown. We decide we want the government to do more and different things. It adds to the size of the government and therefore the cost of the government. Well, you got to pay for that. How do we pay for that? Typically through taxes. There are several different ways you can raise, 1,000 different ways you can raise tax revenue. You've all read in the history books about the Boston Tea Party. That was about taxation without representation. You remember that, I'm sure. It was about the tax on the sale of tea. And of course, that was one of the factors that led to the revolution. So that is a tax on a sale, in the trade. You can have a tax on property. Texas was part of Mexico before it became independent. One of the government of Mexico imposed a tax on property for all of its residents, including settlers in Texas. Well, they decided in order to create an incentive to attract people to Texas to settle the land, they would exempt settlers from that property tax. Well, in 1830, the government changed its mind, reimposed the property tax for the settlers of Texas, and that was one of the factors that led to the drive for Texas independence. So you can tax trade, sales, you can tax property, you can tax income. In 1913, the federal government adopted the 16th Amendment to the Constitution. that allowed the taxation of income. It wasn't a brand new idea. There were a few states that actually taxed income before that time. Hawaii in 1901, well, that's before it became a state, but Hawaii was taxing income. Wisconsin in 1911, Mississippi in 1912, clearly before the federal government was able to. But that started a trend. By 1920, there were 10 states taxing income, and more and more, obviously, since then. We're over 40 now. Some states, Tennessee, for instance, used to tax income, and in recent years has decided not to. So the number keeps bouncing around. So that's the history. Then let's look at what factor each state's individual identity, resources available, et cetera, play. Texas is one of the 9 states that do not impose an income tax. Well, if you look at that list, 5 of the 9 are states with a lot of mineral resources and oil and gas. Alaska, Texas, Wyoming, Nevada, North Dakota. Well, it's pretty easy for a state to tax energy production. There's no consumer that has to pay that cost. It's a more popular tax, easier money for the state. Not every state, of course, has that ability. So they have to raise money with the resources that they have available. Most states have a mix of taxes, obviously. You pay property tax, you pay sales tax, you pay any number of taxes and fees. Those states that depend on fewer sources of taxes usually wind up with larger tax rates on the taxes they impose. For instance, we pay probably a larger property tax bill than people in most other states. That's just the trade-off. So you've got a mix of taxes, you've got a history. Let's talk about state taxes then. I think the bottom line for what I've just gone through is they made the decisions to arrive at this point in time. They've got these taxes. There are a lot of debates about what's a better way to do it. We're not going to touch that today. We're just going to recognize that we've got states with an income tax and states without. So a rule of thumb, let me get into how does that relate to us? We are going to obviously get about 200 state tax returns. Well, how do we spot them? Mostly through tax forms. We're going to see on the W-2, that'll be the one most common. It's most common for every tax, across the board, all taxpayers. It'll be the most common one for state income. Now, state income is going to be determined by where the income was earned. We're going to have clients who, they live in Texas, their main residence is in Texas, but they have professions or activities that carry them to other states. We have one client who comes back year after year. She runs cheerleader camps in Texas, but also in a number of states. She's had anywhere from 3 to 6 state returns each year. We have clients who work on the pipelines. Their residence is in Texas, yet they live in Oklahoma. They'll live in all these other states where they work on the pipeline, and they earn the money while they're working in that state. Therefore, it's considered income of that state. So W-2, keep an eye on that. I know we looked at it in our training Monday night, and we pointed out the boxes at the bottom of the page. If you see a state entry, for instance, Oklahoma, Louisiana, anything but Texas, and you see an amount of income shown and possibly withholding, you've got you've got state income, and there's a requirement for a state return. If you see that the employer has put TX for Texas down in those boxes, even if there's income, ignore it. That's just the employer trying to be conscientious to fill out all the boxes that they need to, but it doesn't apply in this case because Texas has no income tax. Ignore that. Other forms will show income as well, 1099-R. A client may have retired in a certain state and subsequently moved to Texas. For whatever reason, that income, that distribution is considered income of that state until determined otherwise. So it's not earned income, that's unearned income, doesn't matter. It's still income. For most states, it's going to be taxed. Now, we're going to talk in a minute about what states tax what types of income. So I won't get ahead of myself, but you're also going to see 1099-G forms, G for government payment. Typically, we'll see that for unemployment, but you'll also see it for a state refund payment. A state refund payment tells you that they filed a state return and they were due a refund. That refund was reported on the 1099-G in the following year. Of course, that leads to another set of questions. Do we count it or not? That's handled in training. I won't go into that here, but that form will show unemployment income, and if it's unemployment income from a state with an income tax, we've got state income. Again, not every state will tax that, but we need to treat it, anytime you see state income at the front end, we need to treat it as if it required a state return and then send it to drop-off. Drop-off will determine the rules state by state to see whether we need to follow through. We'll make that determination. W-2G, so we see that form for gambling, right? We have a lot of clients who drive up to Oklahoma, just across the border, there's a big casino. They'll drive to Louisiana, same thing. Easy to get there, it can be a day trip, it can be a nice weekend. If you play and don't win, so what? If you play and win, you have income. The income was won, say in Oklahoma, that's Oklahoma income, and it is taxable. 1099 miscellaneous, we'll see that form. It also has boxes on it to indicate state income, state withholding, if that applies. That's going to be rare. It's going to be rare. So if you ever see that, send it to us. We'll sort that out. Okay, there's going to be one other form here of income that will typically not be on a tax form, self-employment. If you drive an Uber in California for 4 months and then move to Texas, you've got income in California. And definition of California income, you earn the money while living in California, while you earn the money in California. That technically meets the requirement for a state tax return. We're not going to have a tax form for that, most likely. So that's the kind of situation where if you have any, and at the front end, at the stage of intake, if you have any indication that the client lived or worked in another state, you just need to follow through and ask, did you work, did you earn money there? Gather the information you can, send it to us, and we'll sort that out. It's all doable. It's not difficult. We just need the information. That's probably the most difficult state income to find. So just keep it on your radar that you can have state income that won't present itself on a tax form. We're going to have some tax forms that are mistakes. I've run into, it's not common, but it's not rare either. I'll give you a couple of examples. We had a client who worked in Texas, lived in Texas for years and years and years. He always used his mother's address as his permanent address, gave that to every employer. His mother lived in Little Rock, Arkansas. His employer looked at that, looked at that information, saw that there was a Arkansas address for this employee and treated that income as Arkansas income. Well, Arkansas has an income tax. So each year, his W-2 said he had Arkansas income, no withholding, and he had 20 to 30,000 of income. So it was not a good situation for him. We needed to make a number of calls. This can be fixed, but we need to go through the employer to get a corrected W-2 to fix it. Without the corrected W-2, we are obligated to treat it the way the form reads. We are obligated to treat that client's income as Arkansas income and prepare an Arkansas return. Typically, what I would do in that case is I would prepare that return, give it to the client and say, hold on to it, don't file it while you're going through the process of contacting your employer. But you're ready in case you need to file it. Other situations would be where a client one client I've been working with for the last 3 or 4 years. She used to work in California. She moved to Round Rock. She has only lived in Round Rock since then. Her W-2 from her employer, she works virtually, her W-2 from her employer has shown consistently that it's California income every year. So every year we need to contact her employer, get a corrected W-2. They've honestly been pretty good about it. It just takes a while because they've got to go to their accounting arm. It just has to go through a process. And you'd rather not have to go through that process. So if you see those, even if the client says it's a mistake, send it to drop off. We will work through the issues. Tell the client that it can be fixed, but we need to treat it as state income according to the law until we can get that form corrected. Okay, you may have a client who says, I used to live in Georgia, I prepared a state return there, I can do state returns. Well, got to be careful with that. That client, or that volunteer, pardon me, can prepare a Georgia return. I'd be comfortable saying that, but every state is going to have a different way that they tax, that they treat income, that they authorize credits, and so on. Every return has different quirks to it as far as how you make it all work. So that volunteer would probably have a leg up in learning how to do other state returns, but that volunteer is not qualified without more training to do other state returns. Please keep that in mind. Again, a reason to send all state returns to drop off. So how do they differ? They can differ based on types of income taxed. Some states, all states are going to tax W-2 income. That's just basic. Social Security income, not so much. Some will tax it, others will not. Retirement distributions, some will tax it, others will not. Still others will tax it above a certain amount. You can exempt up to that amount from being considered income on that state return. It's a nice feature for a number of our clients. Okay, standard deduction. Some states will include a standard deduction, others will not. Those that will not, you know what that means from federal tax returns. That means you're taxed from the very first dollar, assuming there are no adjustments, et cetera, et cetera. Exemptions. There's a concept called exemptions. I know we haven't had exemptions on a federal tax return in however many years. The tax law that was passed in 2017 did away with exemptions, adjusted the standard deduction higher, but exemptions used to mean, and for state returns still does mean, how many people are you claiming on the return? My wife and I claimed our daughter, 3 of us. We would have had 3 exemptions. A larger family obviously has more exemptions. The way it works on a tax return is the number of exemptions times the standard exemption amount is a dollar amount you can subtract from income. Clearly it works to your benefit. Subtracting a larger amount from the income reduces the income, you're taxed on less income. Fairly logical. So that's exemptions. You'll see them on state returns, no longer on federal. Credits. You're going to have a whole variety of state credits allowed. You're going to have state EIC. Sometimes it's triggered automatically by the taxpayer being eligible for federal EIC. New York does that. If you get federal EIC, you're going to get state EIC. Just a question of how much is calculated. But they don't all have it. California has a nice credit for renters. If you live in the state more than half the year and you rent, you are eligible for this non-refundable renter's credit. And it can be a decent amount of money. I've seen it on a number of returns. Okay, the last thing I'll point out is that there are a few states that still penalize taxpayers if they do not have health insurance. Remember that the federal level, there used to be a penalty under Obamacare for not having health insurance. Well, a couple states still have that. California, Massachusetts, the District of Columbia. You'll notice on the drop-off intake checklist, we ask those questions. Did you live and work in another state? If yes, it opens up several more questions. Did you live in California? Did you live in Massachusetts? And further on, did you have health insurance while living there? That's needed so that we can fill out those state tax returns, in case you were wondering. Okay, so we've got variations among states and how they tax, how they offer credits, how they make calculations. You're going to have another layer of complication based on residency. Okay, by that I mean there are 3 types of state tax returns in general, with a few exceptions. If you lived in the state and worked there all year long, you are a resident of that state for that year. You file what's known as a resident tax return. That makes sense, right? If you lived in the state, worked there, but moved either into the state or out of the state during that tax year, maintained a residence while you were there, you are a part-year resident. So you are filing a part-year state tax return. There's a third group of people. If you have income in the state, but never maintained a residence there, never lived there, that income triggers a requirement for a state tax return. However, there is no residency. You are a non-resident. You file what's known as a non-resident tax return. A couple states will combine, like the part-year return, same form as the non-resident return. You'll see that. But we need to treat them differently as far as entering. these different types of returns may have different tax tables, different tax rates. We mentioned credits. They're probably not going to be available to a non-resident. They probably are to a resident if you meet whatever other requirements there are. So we got there's a layer of complication of how they differ from one another with the next layer of complication is 3 different returns for each state. So that gets me back to somebody who says, yeah, I can prepare a tax return, state tax return. Well, not so fast. Let's do a little more training. I would like to spend, we're about halfway through, I'd like to spend the second half of this training on some examples. Let me point out, though, we talked about why a state would have an income tax. It's convenient. It's a lot of money, and it's convenient to administer. Now, it's convenient to administer because they can piggyback on the federal tax return. And you'll see that in the examples. And you will also see that based on the fact that in TaxSlayer, when we prepare a federal return and we have to attach a state return, it's all done in the same file. So when we prepare, federal return, activate a state return, all the relevant information will automatically be carried over to the state return. Well, what does TaxSlayer know? TaxSlayer knows the name, the address, the social security number, date of birth, filing status, all that stuff. Dependents, names, information, same. That's all going to be carried over because that applies on the federal return and on the state return. TaxSlayer also knows what's on the tax forms we've entered. You have a W-2, you've entered all box 1 through 6. That's for the federal stuff, the federal piece. You have box 15 through 18, 19. That has the state information. TaxSlayer knows that, so it's going to carry that over, and it knows where to put it. So a lot of the heavy lifting is done. Well, from a tax preparer point of view, there are some things, sometimes it's as simple as that. Sometimes it's a W-2 only, carries over, you're done. They're a non-resident or they don't otherwise qualify for credits. You don't have to look. It can be as easy as that. But don't be fooled because it's not always as easy as that. Through experience, you learn which states offer which credits, which deductions, is there anything else you can do? We've got military clients who are able to exempt all their income in California. Without knowing that, and you just learn that by experience, without knowing that, you're taxing them in California when they should not be taxed. Okay, I mentioned self-employment also. Self-employment has no tax form, so it's got to manually be entered on the state return. And every state lays those, where you enter it, lays that all out differently. So again, you learn by practice where to go to do that. But we do it, we do it every day. We do these returns every day. We've done enough of them that we know how to do it. We're comfortable with it. Please send them to drop off. Marianne, let's go to that DC return first. So I've got 3 examples, like I said. Before we get to the first example, and you can open up the print file. Oh, I'm sorry, this is Curtis.
Is it 24?
23. Let me just make another point. I mentioned that states piggyback on the federal system. Well, they piggyback on the software, they piggyback on the concept, they piggyback on the filing date, they piggyback pretty much across the board. And yeah, you can go in and open up the DC return. They also piggyback on a lot of the main concepts and terminology. So on a typical return, you are going to, just like on a 1040, you're going to add up the income, get an income total. Then the question is, do we need to adjust? Make any adjustments that are needed. So then you come up with an adjusted gross income total. And then, same as on the 1040, standard deduction or itemized deduction, you're going to deduct whatever amount is available, if that's available in that state. Once you've deducted that amount, you have a taxable income figure. You'll recognize these terms, same as on the federal return. So the taxable income figure, then that starts the tax process calculation. Software will go to the tax table and figure out how much tax liability, meaning how much that state expects to receive based on that amount of income in that year. It'll go to the tax table, figure out that amount, and plug it on the tax line. And then we go through and look for whatever kind of credits are available and whatever kind of payments were made, withholding, for instance. Then we compare the two. If withholding is greater than the tax liability, we have a refund. If it's the reverse, we have an amount owed. This is what we're used to on a federal return. Same concept on a state return. So let's look at this client. If you go to the print, yeah, open that up. This client moved to Austin. Okay, this is a fairly straightforward one, and let's just keep it right here for now. She moved to Austin in February of 2023. This is a 2023 return. She earned money while she was still in DC, but it was just on a single W-2. This is a basic return at any level. But you can see up top, there's 7 pages. This is page 1 of 7. States will have a lot of extra paper. In general, what you'll see is that, the main part of it is up front, and then you get into a little more, more detail, and then you get into a lot more detail if it's needed. We don't always have to go all the way to the bottom if you're just reviewing with a client. And this is what I want. I want you to come away from this training with is, how am I going to review this with a client? So, okay, we've got the Texas address, so we're current. See, everything carried over, filing status. And scroll down just a little. So page 1 on the DC return is real helpful. It's a summary. Tax return information. We can see that her DC adjusted gross income was $14,839. She had tax amount of $581. She had withholding of more than that, $616. She gets a refund. That's easy to communicate to the client. That's easy to understand. It's laid out right there. This is a good one to get if you're doing a pickup.
They can't see the return.
They can't see the screen?
Because it pops up in a PDF.
Oh. Okay. Okay. Can we go back to the PDFs though?
Yeah.
I'm gonna do what you gotta do, Marianne. Okay, I understand that the tax return may not be visible because on our end, it popped up in a PDF. Will this be a fix, Marianne?
Yeah, they can see
Okay,
it.
okay, pardon me, I'll take a sip. Should be fixed now. Okay, let's scroll down. And remember I said we've got the summary up top and then you get into more detail. So we can just, so we're on the second page here and we can see right in the middle of the page here, She was a part-year resident in DC from 1/1/2023, January 1st, until 2/17, February 17th. Okay, not long, but long enough to have been a resident, have maintained a residence, and clearly she was a resident there before January 1st. So this is just all the time in this tax year she was a resident. Now we see 55,726 as her total wages. Well, she worked once she got to Austin. And that is her total, including the DC income. So let's scroll down a little more. And okay, this is where I want to be. So there are no additions to DC income. The 55,726 is still her AGI on her federal return, and it flows over to this return as the first number we see. Subtractions from DC income, you see that line 8, part-year residents, enter income received during period of non-residence. Well, she earned $40,887 once she got to Austin. She did not earn that in DC. It is not DC income. It should not be taxed on the DC return. So the software picked that up and made that adjustment all by itself. If it had not, we would have had to manually do that, and that happens. But this is an easy one. That's why I wanted to demonstrate this one first. So it keeps going down, and you can see 40,887 is subtracted. We get back to that 14,839, which we had originally. Can you go back up just a hair? Yeah. So that gets you to the DC adjusted gross income. Remember, total income minus adjustments gets you to your adjusted gross income. Then we have a deduction amount, 1,821. Well, okay, it's probably like a fraction. There's a percent going on. It's probably not a flat standard deduction. Either way, doesn't matter. It's still a deduction. We subtracted from the adjusted gross income to come up with taxable income. Again, you recognize the terminology. It's the same we use on the federal return. Based on that taxable income, that is the amount of tax, $581, owed for that tax year. And we can keep scrolling down. There are no refundable credits. You can see the total income showing up again. That's the form trying to determine if she's eligible for DC earned income credit. She is not, most likely because of the amount of total income and the fact that she was only there a month and a half. Let's keep scrolling down. Okay, but she had withholding of 616, larger than the tax liability. So just like we saw on the summary page up top, she overpaid by $35. She gets a $35 refund. This is a pretty simple example. And let's not scroll through the rest. I mean, we're on page 5 of 7, and if you are in a situation where you're helping a client with the pickup, this is about all they can handle up through the bottom line. And honestly, that's what they want to know. We will have gone through the rest of it ourselves in tax preparation and review. Trust us, it should be complete and ready by the time we do client pickup. So we don't have to keep going here. Let's click out of this one. And let's go to the next one, the Oklahoma resident.
What was the name on that?
Grappo, Grappo. So our next client was one of our clients who go gambling. She went up to Oklahoma and probably had a long weekend up there and won quite a bit. And like we said, because she won that money in Oklahoma, it's Oklahoma income. And therefore she needs to have an Oklahoma tax return. Typically, these casino winning returns are pretty straightforward, but I wanted to use this one as an example because it's got a different layout and it goes through the calculation in a different way. The DC return we saw, really straightforward. This one goes through a different kind of logic. Okay, so, oh, DC again. Bear with us, please. Okay, here we go. So again, this client, all her other income was from Texas. There was retirement income, there was Social Security, and she had gambling winnings. Only gambling winnings in Oklahoma. Yet you can see up top, it's a 10-page return. Okay. Let's scroll back up just a hair. You can see that we have a calculation on the right side of the page for exemptions. She is claiming herself, you see the number 1, and there's a 1 total. So she has 1 exemption on the return, and that'll come into play later. Now we can scroll down. Okay, you see 2 columns here. This was why I wanted to use this as an example. This is fairly common on state returns. They will lay out the federal amount, which means what's on the federal 1040, and then the state amount, Oklahoma here, and that means clearly the state income. So you see the federal okay, why do they do this? They do this to create a ratio between the two, which they will apply later on. That ratio will be applied to, in some states, the income amount, in other states, the tax amount. In other states, it'll be the exemption amount, or a combination of those. It may be multiple applications of that ratio. Let me walk through, it'll probably be more clear once we walk through, so you can see what that means. So on her federal return, her AGI was $33,363. You can see line 5, and that same column shows Oklahoma subtractions. I looked through this return yesterday, so I knew what was coming, and I identified that that is her Social Security income. So that is an Oklahoma adjustment to the federal information. So we subtract that amount. It means Oklahoma does not tax Social Security. Subtracting that amount gives you an Oklahoma adjusted income based on federal dollars of $26,236. Okay, hold that thought. Let's go to the right side of the page, the Oklahoma amount. She won $9,218 at the casino. And there are no adjustments, no subtractions, no additions. The bottom line is the same number. Then you can see lines 8, 9, and 10, they merge the 2 columns. So we are going to work with the Oklahoma adjusted AGI based on federal numbers, the 26,236. And we can scroll down now. So they carry that number down to the top of page 2. Okay, remember some states allow deductions and exemptions. That happens here. $17,000 is the amount of her deduction. You can see if you read through the bolded information there, that number is larger than any of the amounts shown. That means that she got an extra bump based on her age. She's over 65. So $17,000 is her standard deduction. Remember up top, we counted up the number of exemptions on her tax return. She had 1. And that 1 times the standard exemption amount of $1,000, of course, gives you $1,000. Add those 2 numbers, you have $18,000. So the 18,000 is the total amount we want to subtract from the 26,000 up top, from the Oklahoma AGI. And when we do, we come up with an Oklahoma taxable income of 8,236. Okay, so far so good. And remember, we're using the same sequence of calculations we always use on a 1040. We know the taxable income now. We go to the tax table and we identify that the state expects to be paid $202 based on that income. So that number keeps carrying down because there are no further adjustments at this point. Remember, I mentioned there was going to be a ratio created. It's done on line 18. The Oklahoma amount, 9,218, turns out that it's 35.13% of the federal adjusted, Oklahoma adjusted federal amount, 26,236. So we are going to apply that 35% to the $202. The result is $71. $71 is her tax liability based on her income, her non-residence, everything else on the return. Our client here had no withholding. There are no other credits that come into play. So the bottom line for her is that, yeah, if we keep scrolling down, we'll see, and you got to scroll through that page and keep going. Yeah, the bottom line is total tax is $71. We've got a payment coupon up above for, it tells her she needs to pay $71 to the state of Oklahoma. Okay, we got a different layout here, kind of a different logic in the calculation. It can take a few minutes to sit and stare at it, kind of scratch your head, put all the numbers together, but the bottom line is it follows all of the concepts that we see on a 1040. And I'll make this point again at the end, but let me just state it here. If you are helping a client pick up a return, you don't really need to go through line by line. I mean, how often do you do that on the 1040? You can, clearly, and the client may ask you to, and that's fine, do it then. But a whole lot of clients, they're glazed over by this point. Stick to the concepts you know. You know AGI, you know taxable income, you know tax due, you know credits, you know refund, you know amount owed. That's the guts of the return. Okay, I've got one more example, and it's kind of a mix of the two. It's a California return. Duhan is the last name. So this client is retired military. He had a 1099-R, so retirement income from the military. That retirement income, that retirement document showed that his income was all considered to be California income, even though he lived in Texas. That's based on the fact, my understanding is it's based on the fact that he always had his permanent residence, probably throughout his service, as a California residence. So clearly, that's California income. Clearly, that triggers a California return. Okay, remember the Oklahoma return for a single line of gambling winnings was 10 pages. Remember the DC return for a single W-2 was 7 pages. California's got them all beat. And I've seen longer California returns than this. Actually, let's go to no, you're good right here. So it carries all the information over, but you can see it's a 12-pager. We're not going to go through all 12 pages, but you can see California has an exemption. And this gentleman qualifies in two ways for that exemption. His personal exemption, you see the number 1 for himself, he's the only person on the return, is worth $144. However, he's over 65. He qualifies for the senior exemption. Again, one person times 144. So if you scroll down a little bit, it'll add the two numbers together. The total, of course, is 288. Hold on to that thought. It'll show up later. Line 13 shows that we're using federal information again. Oklahoma had federal information in its own column, and then state information in its own column. Two separate columns. And then they brought them together partway through the calculation. California doesn't do that. They put everything in a single column. Let's work through it. Federal AGI, 40,479. That's from, that matches the AGI on his 1040. California adjustments, 10,760. Again, I looked ahead so I would know what was coming. That is his Social Security. California does not tax Social Security. Software knows that. It makes the adjustment. So we subtract that amount, we come up with 29,719. There are no other California adjustments. So we can jump down to line 17. Adjusted gross income from all sources. This is the California adjusted gross income from all sources. All sources meaning it's the federal numbers we're working with. In the case of this client, there was no income in Texas. He had Social Security, he had retirement income. So Social Security we've removed. Everything that's left is his retirement income. So it is same federal and California. So we've got a California AGI. We have, pardon me, a standard deduction. And that's 5,363, likely not itemized, got to be standard. Why it's not a round number? I don't know, California only knows that. So we subtract that, we come up with a taxable income figure. Same process, you recognize the terminology. Based on that taxable income figure, we go to the tax table. The tax table tells us, line 31, that the client has a, pardon me, a tax liability of $384. This page, this section of this page is always confusing. I'm just gonna jump around, so I'm gonna hit the key points for you. You can see line 35 repeats that California AGI figure, 24,356. Then line 36 shows the California tax rate, 0.0158. And line 37 has the calculated tax based on the AGI and the tax rate. It's $385. You'll notice it's $1 more than we have in line 31. It's got to be rounding. Why those two numbers show up with a rounding difference? I don't know the answer to that. Treat it as the same number. Exemption credit amount. This client is eligible for an exemption credit, which is a California feature, at 100%, 1.00. And so remember above, we calculated that he was due an exemption based on himself, claiming himself, and on the fact that he's over 65. 144 and 144, we get 288. Okay, this is where it shows up again. Line 39 shows 288. The math from this point on is simple. We subtract 288 from 385, and the result is $97 in what's basically an adjusted tax owed. And we can keep going down. Nothing happens, nothing happens. There are no other credits, is what that means. The 97 keeps carrying down. It is the total tax there. He had withholding of 240, line 81. So he's in good shape. He overpaid. Again, same as on a federal return. You overpay, you get a refund. That's the gentleman's situation. He overpaid by 143. 143 is his refund. And we are 4 pages through a 12-page California return. The rest of the pages are going to give detail on what we've seen above. I'm not going to spend time on it. What I want to just communicate with the last minute that I have is just to repeat what I've said throughout this. You know how to do this. This isn't rocket science. It's the same concepts we're trained on for a federal return, the same terminology. It is convenient for these states to piggyback on the federal system. It's convenient for us that they do. We can use the same software. We can calculate both returns, not a problem. And we're working with the same terminology. You see California added some, a proration of an exemption. Okay. We were able to sort out what that meant. They're going to introduce some of their own terminology, but we can figure it out. These are 3 pretty good examples of state tax returns. I hope you're more comfortable now than you were earlier this morning with the prospect of helping clients when they come in to pick up their returns, federal and state. You may have questions. The client may have questions, and you may not feel like you're able to handle it. Feel free to we are in drop-off. We're in contact with the clients on a regular basis through phone calls, emails, and texts. It's an entirely appropriate answer for you when you're helping them pick it up to say, send a text message to Andy if you have further questions, send an email. We are happy to go line by line in any level of detail the client wants. We want the client to understand the state return. We want the client to be happy. Happy to do that. That's all I have. Are there chat questions or anything?
No.
Okay. Thank you, everybody. Have a good tax season.
Andy, I remember you saying the other day that